Ever wondered what the stock market is all about? It's basically a big marketplace where people buy and sell pieces of companies. These pieces are called stocks. When you own a stock, you own a tiny part of that company. Companies issue stocks to raise money for things like expanding their business, building new products, or hiring more employees. When you buy a stock, you become a shareholder, which means you have a say in how the company is run. Shareholders usually get to vote on big decisions the company makes. Overall, stocks are a way for people to invest in companies and share in their success. It's like being a part owner of your favorite businesses, and it can be a way to grow your money over time. How does the stock market work? The stock market is like a giant store where companies sell their stocks to raise money. Investors buy these stocks and become part owners of the company. The stock market is where these transactions happen. One important thing about stocks is that their prices fluctuate. This is because the value of a company can change based on lots of things, like how much money it's making, new products it's launching, or changes in the economy. If a company does well, its stock price often goes up, and if it doesn't do well, the price can go down. People buy stocks with the hope that the company will grow and become more valuable over time. If that happens, the value of their stocks goes up, and they can sell them for a profit. Some companies also pay a part of their profits to shareholders in the form of dividends, which is like a little bonus for owning their stocks. Types of stock. 1. Common stock. This is the most common type. If you own this, you get to vote on some company decisions and might get a share of the company's profits as dividends. 2. Preferred stock. This type doesn't give you voting rights, but you might get more of the company's profits before others if things go wrong. Some big companies in the stock market. Several companies dominate the stock market, often referred to as blue-chip stocks due to their stability and reliability. Some of the largest stocks by market capitalization include 1. Apple, a technology giant known for its iPhones, iPads, and Mac computers. 2. Microsoft Corporation, a leader in software development, known for products like Windows and MS Office. 3. Amazon.com, a multinational conglomerate focusing on e-commerce, cloud computing, and digital streaming. 4. Alphabet, the parent company of Google, dominating internet search and advertising. 5. Tesla, renowned for its electric vehicles and clean energy products. Where can you buy stocks? Buying stocks is easier than you might think. There are online places called brokerage platforms where you can do it. Some popular ones are Robinhood, TD Ameritrade, E-Trade, and Fidelity. 1. Robinhood. Robinhood is popular for its easy-to-use app and website, making it accessible for beginner investors. It's known for offering commission-free trading, meaning users can buy and sell stocks without paying fees. 2. TD Ameritrade. TD Ameritrade is renowned for its extensive selection of investment options, including stocks, bonds, mutual funds, and more. Additionally, it provides a wealth of educational resources, such as articles, videos, and webinars, to help investors make informed decisions. 3. E-Trade. E-Trade is recognized for its advanced trading tools and research resources, catering to both novice and experienced traders. It offers a diverse range of investment products, from stocks and options to futures and forex, empowering investors with comprehensive trading capabilities. 4. Fidelity. Fidelity stands out for its robust research platform and retirement planning tools, making it a top choice for long-term investors. It provides extensive market analysis, financial insights, and retirement calculators to assist users in achieving their financial goals. Stock market volatility is a key concept that plays a significant role in shaping investment strategies and outcomes. It refers to the degree of variation in trading prices of stocks over a certain period of time. Essentially, it measures how much and how quickly stock prices change, reflecting the level of uncertainty and risk in the market. Volatility is influenced by a multitude of factors, including economic indicators, geopolitical events, corporate earnings reports, investor sentiment, and market liquidity. For example, unexpected changes in interest rates, inflation rates, or geopolitical tensions can trigger sudden shifts in market sentiment, leading to increased volatility. Similarly, company-specific events such as earnings announcements, product launches, or management changes can also impact stock prices and contribute to volatility. High volatility can create both opportunities and challenges for investors. On one hand, it can offer the potential for higher returns, as volatile markets may present buying opportunities when stock prices temporarily dip below their intrinsic value. Savvy investors may capitalize on these fluctuations by buying undervalued stocks and selling them when prices rebound. On the other hand, volatility also increases the risk of investment losses. Sudden and unpredictable price swings can lead to significant portfolio losses if investors are caught off guard or if they have overexposed themselves to volatile assets. Moreover, heightened market volatility can amplify investor anxiety and exacerbate emotional decision-making, leading to impulsive actions such as panic selling or buying on momentum. To navigate market volatility effectively, investors should adopt a disciplined and diversified approach to investing. Diversification across asset classes, sectors, and geographies can help mitigate the impact of volatility on overall portfolio performance. Additionally, maintaining a long-term perspective and adhering to a well-defined investment strategy can help investors stay focused on their financial goals amidst market fluctuations. Furthermore, staying informed about market developments, conducting thorough research, and seeking guidance from financial advisors can provide investors with the knowledge and tools needed to make informed decisions in volatile market conditions. By understanding and embracing market volatility as an inherent part of investing, investors can position themselves to navigate uncertainty and capitalize on opportunities for long-term wealth creation. Most asked questions in the stock market. 1. What's the difference between bull and bear markets? A bull market signifies a sustained rise in stock prices, while a bear market denotes a prolonged decline. Bull markets are characterized by optimism, while bear markets indicate pessimism. 2. How do I start investing? Begin by educating yourself about stocks and investment strategies. Choose a brokerage, create an account, and start with careful research and small investments. 3. Are stocks risky? Yes, stocks carry risk due to market volatility. However, risk can be managed through diversification, thorough research, and a long-term perspective. 4. What determines stock prices? Stock prices are influenced by supply and demand dynamics, company performance, economic indicators, and investor sentiment. Positive news can lead to price hikes, while negative news can trigger declines. 5. What are dividends? Dividends are payments made by companies to their shareholders as a share of profits. They provide a regular income stream to investors. 6. What's the role of index funds? Index funds are investment vehicles that mimic the performance of a specific market index, such as the S&P 500. They offer diversification and are often recommended for long-term investors. 7. How can I stay informed about stocks? Stay updated through financial news outlets, stock market apps, and official company reports. Knowledge empowers informed investment decisions. 8. When should I buy or sell stocks? Timing the market is challenging. Instead, focus on a well-defined investment strategy, whether it's long-term growth, value investing, or income generation.